Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to the bigger picture with me, Ryan Huang. And we've got lots to talk about this week. And to help us navigate what's to come for markets, we've got Rodda. He's the Senior Financial Market Analyst at Capital.com. Carl, good morning. How are you doing today?
Good morning. I'm doing very well. Thanks for having me.
Well, lots to unpack as we look at a couple of things. First, let's go to the US, where we have the first crypto summit hosted by the White House. So we have crypto in focus these days. Of course, President Donald Trump has been quite pro-crypto. What were your takeaways from that event?
I think it underwhelmed people, really. I mean, I guess the price action speaks to that this morning. But, we had the announcement of, how the strategic reserve might be constructed last week and how it might be established. And for the most part, I think there was a level of, again, disappointment, an underwhelming kind of attitude as to how things will actually be established and how active the government will be in actually purchasing crypto and building this reserve. So, for the most part, you can also probably throw in there too that there was a little bit of confusion about some of the altcoins that might be included in any kind of reserve. For the most part, I think, again, it's been met with a degree of disappointment in terms of, perhaps a lack of boldness comes to the strategic reserve, arguments about the merits of the reserve itself aside. And again, it doesn't seem to be inspiring much sort of bullishness in crypto. In fact, quite the opposite. It seems to be disappointment and a level of bearishness.
Yeah, that crypto summit gathering some of the industry players, leaders of various digital asset firms. So some disappointed that it did not signal more support for industry in terms of the Bitcoin stockpile or strategic reserve. It will just involve what's been seized by federal enforcers, nothing about buying new crypto. So I think that went to some pressure on crypto prices. And talking about Donald Trump, we've got tariffs underway this week as well. In fact, China's tariffs on the US kick in today. And we've got the two sessions that are underway. They conclude today. What have been some of your takeaways from the two sessions so far?
Basically, it was as expected. I didn't see anything that really exceeded expectations in terms of the growth targets, the inflation targets, how it's sort of looking to fund some of these, additional stimulus measures going forward. The recapitalization of the financial system, the growth, like I said, the growth target of about 5% was more or less in line with expectations. Sort of implies that, given the current growth trajectory, there might be further fiscal and monetary support provided without that being really highlighted at the actual conference. But for the most part, it showed that the Chinese leadership is looking much more to the private sector and partnerships with the private sector to try and improve the productive capacity of the economy, improve growth from a cyclical point of view, and trying to align a little bit more some of the longer-term strategic imperatives that I think the central government has been trying to drive over the last few years, and that's around, greater independence, economic modernization, decoupling from the United States, dealing with some of the excess debt in the system, while also driving an actual uplift in short-term economic activity, which I think that the central government sees coming through the private sector, especially sort of the tech industry and specifically some, investment in artificial intelligence. So for the most part, I think, again, it wasn't really anything that delivered, significant surprises, but I do think it hit the right notes in terms of what market participants were looking for. In terms of initiatives to actually support the private economy and support growth going forward as well.
Yeah, just look at those tariffs. Recently, we've got Donald Trump increasing those China tariffs to almost 20% on some imports. That prompted China to retaliate by putting tariffs of 10 to 15% on farm goods and other U.S. exports. And against that backdrop, there's now rising speculation that China could roll out a significant stimulus package in order to boost its economy. So does it mean it could be in for some tailwinds, at least for the Chinese stock markets?
Yeah, I do. Although I think that, most of the tailwinds are actually coming through the private sector. And I think the most important thing here to note is that the really big change that has happened over the last 6 weeks, two big changes that have happened over the last 6 weeks in the markets is first is DeepSeek development, which sort of suggests that China's industry is at least bridging the gap with the United States in terms of this kind of technology, AI arm. And the other element to that as well is that as opposed to the last 3 or 4 years where there's been a sort of combative and adversarial approach to the private sector, or certainly perhaps outright hostility towards the private sector and looking to kind of keep, business and especially the technology industry kind of in check, the central government seems to be making the right overtones that it is wanting to unlock the power of private enterprise and specifically partner with some of these major technology firms to drive economic activity going forward. And I think that's the really big development, because one thing that we understand about China's economy here is that the central government has, a fairly healthy balance sheet, but households are doing it tough. Businesses are highly leveraged, and the local governments remain highly leveraged in a really sticky position as well. The private sector does have some degree of capacity to drive economic activity here. And if they take some of the handbrakes off the private sector, that can be the kind of growth driver to actually genuinely support the economy and allow it to sort of progressively recover over time as it deals with these other kind of, again, much more long-term and structural headwinds. So that's the big development. Those sorts of positive signals towards the private sector and the tech industry is the reason why I think asset prices are really starting to pick up, as opposed perhaps to just more stimulus measures, which have kind of constantly disappointed the markets and then also not manifested in the kind of lift in economic activity that I think everyone was hoping for.
Yeah, Carl, let's look at the Chinese economy. Do you think things have bottomed out? Because looking at some of the data, consumer inflation dropped by more than expected and was below zero for the first time in 13 months. And that's always seeing some pressure on oil prices because of that gloomier outlook.
There are certain things that aren't going to go away overnight, and that they're going to either take some really radical measures to fix, or perhaps even a bit of a backflip on some of these other sort of policies implemented over the last couple of years that have been, again, designed to kind of restructure China's economy and deal with some of those longer-term issues that had built up over a very long time. I don't think it's going to abandon that kind of sort of longer-term mindset. And as a result, the fundamental issue here as we sort of confront the sort of headwinds to Chinese economic growth, again, relates back to, obviously, local governments, the property sector, and household balance sheets. And the problem there is obviously excess leverage and a lot of debt that still sits on those private balance sheets and local government balance sheets, which means that, consumption's being deferred, confidence remains very low, retail spending is very low, businesses investment is very low, construction activity is very low as well. And the problem is that effectively we have to see this kind of, slow rundown and improving balance sheets, which actually happens over a longer term time period, and you can't really just sort of flick the switch overnight to actually address. Again, going back to my previous point, I think the reason why markets are much more positive about China is that they're turning to other growth engines to try and steer the economy forward, rather than just sort of hoping and relying that some of those big, deep-seated issues will improve faster than expected. It's not going to go anywhere very quickally. So, again, we're going to still see these kind of deflationary pressures coming through. However, there are now other drivers looking to sort of improve, economic fundamentals going forward. It should offset a little bit some of those kind of significant headwinds, although, again, those headwinds aren't going to go away. They're going to be really settling and slowing China's economic potential for years from here, realistically.
All right, Carl, a quick look ahead to the week. We've got some data on tap for the US, and that includes some consumer numbers or consumer inflation numbers. And in the past week, we saw some weaker than expected jobs report numbers coming through. What are we expecting on this front?
Yeah, the data in the United States has deteriorated significantly over the last few weeks, and some of that is just a part of what was already going to be a sort of a modest slowdown. The other part, of course, is the impact of trade restrictions, or just the uncertainty generated by some of these tariffs by the Trump administration going forward. Consumer spending has been a little bit disappointed. Surveys of consumer confidence have been weak. Business activity surveys have shown that there are already signs of a slowdown because of, again, policy uncertainty. That has brought forward the timeline for when the Fed is expected to cut interest rates to potentially June. The fear is, however, that maybe because of this kind of upward pressure on inflation expectations and maybe the impact of these price shocks coming through from tariffs progressively over time, that maybe inflation won't come down as demand starts to moderate, and we'll get this kind of stagflationary-like scenario. So the data this week is expected to show a bit of an easing in inflationary pressures. That won't necessarily capture, of course, a lot of the supply-side issues that could keep prices fairly sticky. But what the markets are really going to need to see here is that if growth is slowing down and we're confronting the US economy that is, dealing with these, fairly big policy measures, that at least, if nothing else, the Fed might be able to cushion the markets, might be able to cushion the economy with interest rate cuts because of lower inflation. So, again, it's not necessarily going to manifest fully this kind of trade uncertainty and tariffs in this particular figure. But if we see an upside surprise in the inflation data that suggests that we're working from a higher base than expected before these tariffs and other things that could put upward pressure on inflation hit, that's going to really raise fears for markets about where interest rates will go from here, how strong corporate profitability, profit margins might be, and that will really put some downward pressure on prices. So it could be really significant given the weaker economic backdrop if we don't see inflation continue to move lower from here.
All right, great look ahead to what's to come for investors to watch out for. We've been in conversation with Rodda. He's the Senior Financial Market Analyst at Capital.com. Carl, always a pleasure chatting with you. Thanks so much for your time.
Thanks for having me again.
All right, catch up with you again soon. Stay at Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.